diversity often separates the truly successful entrepreneurs from the rest. 6. Social responsibility is good business. Schultz's emphasis on ethical sourcing of coffee beans and his philanthropic ventures highlight his commitment to corporate social responsibility. This approach underlines the fact that businesses can be profitable while also making a positive impact on society. 7. Balance work and life. Despite the pressures of running a global brand, Schultz has always prioritized his family. This balance between work and personal life is a lesson for all, illustrating that success in the business world should not come at the expense of personal relationships. From humble beginnings, Howard Schultz has risen to be an icon of entrepreneurship. His journey, filled with both triumphs and difficulties, has transformed a local coffee retailer into a global phenomenon. Schultz's success story illustrates the power of visionary leadership, corporate responsibility, and ability to learn from failures and persist to ultimately reach success. Don't forget to get a look at my portfolio if you want to have 10% more return each year on your investment than if you invested in the S&P 500 with a very low risk. I show you how to do that and copy-paste my personal portfolio in the link in the description of the video. If you like this video, I'm sure you'll love this incredible story too. Don't forget to hit the like button and subscribe to the channel, and I'll see you in the next video. Thanks for watching. Goodbye.
You want to invest in the stock market, but don't know anything about trading? ETFs are a good way. In this video, we will first explore what are ETFs, their intrinsic values and drawbacks, and at the end of the video, we will compare various ETFs to help you make more informed decisions and align your ETF choices with your overall investment strategy and risk tolerance. First, what are ETFs? ETFs, or exchange-traded funds, are a class of investment funds. Much like stocks, they're traded on major exchanges. An analogy might be seeing them as a basket, a collection of assets, be it stocks, bonds, or commodities. They are proposed by various issuers such as BlackRock, Vanguard, Schwab, and Slate Street Global Advisors for the most famous. There are different types of ETFs. They can be classified depending on the asset type, stocks, bonds, real estate, currencies, or commodities, for example, or depending on the market location, US, entire world, Asia Pacific, Latin America, or depending on company's size, large caps, mid caps, small caps, or depending on sector, such as energy or healthcare, for example, or depending on whether they represent a physical or a synthetic replication of the assets they include. Let me explain. In the case of physical replication, when you buy the ETF, you do buy, for example, the stocks included in it, while in the case of synthetic replication, you do not. The ETF only tries to mimic as closely as possible the value of the stocks included in it. Or they can also be classified depending on whether they are based on growth or on dividends. Let me explain. Companies might decide to keep their profit to further develop and expand, or they might pay part of their profit as dividends to their shareholders. Let's explore the advantages of ETFs. When you buy an ETF, you basically buy a whole lot of assets. Of course, this has several advantages. Diversification. With a single purchase, you can have exposure to a plethora of assets. Flexibility. ETFs can be sold or bought anytime during trading hours. Cost effectiveness. Generally, ETFs have low expense ratios below 0.1% and are much lower than traditional mutual funds. It's easy and fast to implement. You basically have no research to do to know what to buy. Hence, it is very little work, and even if you know nothing about stock exchange, it's really straightforward. Dividend yields. Many ETFs offer attractive dividend yields. This is great if you want to live from your investment, but on the other hand, you should keep in mind that a dividend is money which is not reinvested to grow the business. However, it's not all rosy. Let's now see the downside of ETFs. Some challenges of ETFs include liquidity issues. Not all ETFs are highly traded. This might be a problem if you need money and want to sell quickly. Tracking errors. Sometimes, the synthetic replication ETFs might not precisely mimic the indexes they track. Minimum investment. Certain ETFs require a minimum amount to be invested. Based on this, let's see the criteria you should consider before buying. Before plunging into the ETF market, it's pivotal to evaluate several factors to ensure a sound investment decision. Objective. Begin by understanding the core goal of the ETF. Is it growth-oriented, value-driven, or focused on income generation? Market cap. The total market value of an ETF provides insights into its size and stability. Larger market caps often imply more stability, albeit with potentially lower growth prospects. Performance. Historical performance, while not an indicator of future results, offers insights into the ETF's track record in various market conditions. Composition. Scrutinize the assets within the ETF. A diverse composition can mitigate risks associated with any single asset class. Concentration. Ensure that the ETF isn't overly reliant on a few assets. High concentration can lead to increased volatility. Turnover. A high turnover rate can indicate frequent changes in the ETF shares, potentially leading to higher costs, while a low turnover might suggest a more stable buy and hold strategy. Max drawdown. This measures the largest single drop from peak to bottom in the value of a portfolio. A lower max drawdown can suggest lesser volatility and risk. Dividend. Examine the ETF's dividend yield and history. A consistent dividend payout might indicate a stable set of underlying assets. Expense ratio. This represents the annual fee that all ETFs charge their shareholders. It's crucial as it does impact net returns. It should be checked in light of the performance. For example, an ETF with a higher expense ratio but a high performance might be more valuable than one with a lower expense ratio but also a lower performance. Liquidity. Ensure the ETF trades sufficiently, facilitating smooth entry and exit points. With these criteria in mind, we will now examine different types of ETFs from the main issuers to help you select the best ones for you, depending on your objectives and investor profile. We will first compare 3 ETFs tracking the total US market. 1. The Vanguard Total Stock Market ETF, or VTI. It is an exchange-traded fund offered by Vanguard that aims to track the performance of the CRSP US Total Market Index. This index encompasses the entire US stock market, including thousands of stocks from companies of all sizes and sectors. 2. The iShares Core S&P Total US Stock Market ETF, which is traded under the ticker symbol ITOT. This ETF aims to provide investors with broad exposure to the entire US stock market, including large, mid, small, and micro-cap stocks, listed on the NYSE and NASDAQ stock exchanges. It is issued by BlackRock. 3. The Schwab US Broad Market ETF. With the ticker symbol SCHB, this ETF aims to track the performance of the total US stock market by tracking the Dow Jones US Broad Stock Market Index, providing investors with broad exposure to US stocks. It is issued by Schwab. Here is a comparison of the performance of these ETFs in the last 10 years using the site portfoliovisualizer.com. Actually, all 3 graphs are overlapping, and if you had invested $10,000 in 2013 and reinvested the dividends, you would now have roughly $37,000 with all 3 ETFs. This corresponds to an average annual growth of about 13%. The max drawdown in all 3 cases is about minus 24%. Let's now compare in detail the main criteria we discussed earlier for each of these 3 ETFs with the site seekingalpha.com. The market cap is much higher for VTI, with $317.62 billion, and there is also a much higher liquidity for the ETF, with 2.81 million shares exchanged daily, corresponding to $621 million, while ITOT and SCHB are only $95 million and $34 million, respectively. The other criteria holding, expense, and dividends are similar between all 3 ETFs. Hence, I think that VTI represents a much lower risk ETF. Let's now compare ETFs tracking the global market. 1. The Vanguard FTSE All World ex-US ETF, with the ticker symbol VEU. This ETF is managed by Vanguard and aims to track the performance of the FTSE All World ex-US index. The index includes large and mid-cap stocks from both developed and emerging markets, excluding the United States. VEU can be a useful tool for building a well-rounded and internationally diversified investment portfolio. 2. The Vanguard Total World Stock ETF, with the ticker VT. This ETF is also issued by Vanguard and aims to track the performance of the CRSP US Total Market Index, which includes both US and international stocks. It provides investors with exposure to a broad and diversified portfolio of global stocks. 3. The iShares Core MSCI EAFE ETF, with ticker symbol IEFA. The issuer is BlackRock, and it seeks to track the MSCI EAFE IMI index, composed of large and mid-capitalization developed market equities, excluding the US and Canada, but including Europe, Australia, and the Far East. 4. The Schwab ETF SCHF, which stands for Charles Schwab International Equity ETF. It is an ETF offered by Charles Schwab tracking the performance of the FTSE Developed ex-US Index. The index includes large and mid-cap stocks from developed countries outside the United States. Let's first analyze a graph comparing the performance of the 3 ETFs excluding the US market, VEU, IEFA, and SCHF, in the last 10 years. If you had invested $10,000 in 2013 and reinvested the dividends, you would now have about $17,000 with SCHF, $16,000 with VEU, and $17,700 with IEFA. This corresponds to an average annual growth of about 5.16%, 4.55%, and 5.51% respectively. The max drawdown in 2 cases is about minus 27% and minus 28% for IEFA. If you remember the previous analysis, for the US total market, the average annual growth was around 13%, while the max drawdown was in the same range as those ones. Hence, let's compare now VT and VEU, which respectively include and exclude the US market. There is a huge difference of performance of these 2 ETFs, with an average annual growth of about 8.99% for VT, which includes the US market, and only 4.55% for VEU, which excludes it. About half the performance with a max drawdown in the same range, minus 25% versus minus 27%. Let's now compare the other criteria for all 4 ETFs. The number of holdings is similar for VEU and IEFA, around 3,000 companies, while it is of about 1,500 for SCHF and 9,600 for VT. The expenses and dividends are within the same range for all 4. The market cap is about $30 billion for VEU, VT, and SCHF, and $98 billion, about 3 times more for IEFA. Similarly, the liquidity is around $100 million for VEU, VT, and SCHF, and $442 million, about 4 times more for IEFA. Hence, I think that IEFA is clearly the best if the US market is excluded, with higher market cap, higher liquidity, and higher performance. But as we have seen before, the performance is much higher when the US market is included in the ETF with VT. The choice of including or not the US market depends on you and your strategy. We will now compare the ETFs which track the S&P 500 index, which is the stock market index tracking the stock performance of 500 of the largest companies listed on the stock exchanges in the United States. We will analyze 1. The Vanguard S&P 500 ETF with ticker VOO is a popular exchange-traded fund that is proposed by Vanguard. 2. The iShares Core S&P 500 ETF, which trades under the ticker symbol IVV. It is issued by BlackRock. 3. The SPDR S&P 500 ETF Trust, with the ticker SPY. The issuer of the SPY ETF is State Street Global Advisors. SPY is structured as a unit investment trust, UIT. It holds the actual stocks in the S&P 500 in the same proportions as the index. Let's first assess the performance of these ETFs. As could be expected, all three graphs are overlapping and performance over the last 10 years are similar, with an average annual growth of about 13% and a max drawdown of about minus 23%. Hence, we have to examine the other criteria to check if there is any difference. SPY shows a higher market cap with above $400 billion, while the other two are about $300 billion. Similarly, the liquidity is also much higher with $32 billion exchanged daily for SPY, while VOO and IVV are only around $1.5 billion. The other criteria are similar, except for the expense ratio, which is 0.09% for SPY and 0.03% for the other two, 1/3. This is rather high. Hence, I would rather recommend VOO, which shows the best dividend yield and growth rate of the other two. You might be interested in living from your investment, and therefore from an income-oriented portfolio. Let's now see ETFs which have been designed mostly to pay high dividend rates. We will analyze 1. The Vanguard High Dividend Yield ETF, with the ticker VYM. It is offered by Vanguard and aims to track the performance of the FTSE High Dividend Yield Index. This index includes a broad range of large cap and mid cap US stocks, primarily focusing on those with above average dividend yields. 2. The iShares Select Dividend ETF, or DVY, issued by BlackRock. The ETF tracks the performance of the Dow Jones U.S. Select Dividend Index, which is composed of high dividend yielding U.S. equities. Historically, this ETF has had significant allocations to sectors like utilities, financials, and industrials, among others. However, this can change over time. 3. The Schwab U.S. Dividend Equity ETF, with the ticker symbol SCHD, which is managed by Charles Schwab. This ETF is designed to track the performance of the Dow Jones U.S. Dividend 100 Index, which includes high dividend yielding U.S. stocks. If we first compare the performance of these ETFs over the past 10 years, SCHD is clearly above the other two with an average annual growth of almost 13%.